As requested by many of you in the last few days, today we are going to deep dive into ASML Holdings and do a deep analysis. In the last year, the stock have underperformed the S&P 500, at least for the last 3 years. It had a 10% drop with this new DeepSeek AI announcement. Year over year, it's minus 20%. The forward PE is actually 27. So is it an opportunity? Because it's not low, but it has been higher in the past. So 27, can it represent an opportunity now that is under 30? The market cap is 254 billion euro. And on January 29, it opened on pre-market with plus 10-11% because they had results better than expected. They can potentially expect lower capex spending from their clients, and you will analyze all of this in this video, okay? For the last 5 years, ASML have outperformed the S&P 500. So S&P 500 returned 98%, ASML 158%. So it's a great outperformance. But as you can see, in the last 2-3 years, it has been more difficult. So in this video, we are going to cover all the business, the numbers, if there is a moat or no, and how strong is the moat, and of course, at what price it can be interesting to invest in ASML if you think it's a good company, if you think it's interesting to invest. The history of the company started in 1984, where ASML was founded as a joint venture between Philips and Advanced Semiconductor Material International, so ASMI, in the Netherlands. This marked the beginning of ASML's journey to develop photography system to the semiconductor industry. In 1991, introduction of the PAS 5500 lithography system, it was a breakthrough that became a bestseller, and it established ASML as a serious competitor. In 2001, they acquired Silicon Valley Group, SVG, for $1.6 billion. This acquisition gives them access to critical technology and strengthened their position in the market. 2010, they launched of extreme ultraviolet EUV lithography. The first machine was the NXE3100. It revolutionized the market by enabling smaller, more powerful semiconductor. Today, we're in 2025. They are still leader on this. Nobody is able to still compete on this field, okay? On the EUV market, they are still the leader. In 2023-2024, they created a new generation of high NA EUV lithography systems. Each machine is sold for around $315 million. The first one was sold to Intel, and it's in Oregon factory today. They plan to sell 20 units per year by 2028. Okay, so how they make money? It's easy. They have 2 ways of making money. First way is net system sales. Okay, so it's lithography machinery sales. 80% of the revenue. The 3 bestsellers are EUV, so extreme ultraviolet. So they don't say which machine in the EUV, but it's generally EUV. And then other of the bestsellers are from DUV, so deep ultraviolet, R5 and KRF. So I'm sorry if I didn't pronounce it correctly, but you got it. Then the second way to make money for them, it's service. It's 20% of the revenue. It's service to keep the machines up to date, do maintenance and technical support. It's important because it's very regular revenue and improve relationship with client. It can bring trust, and thanks to this, on the long run, clients will stay with ASML instead of going to competitors, if even one day there is a competitor. So here, the global circuit for a semiconductor ASML, it's in number 5, okay, so using EUV lithography to chip pattern and burn into the resist in exposure step. Okay, so it's probably one, not saying the most important because everything is important, but this number 5, it's one of the biggest market in the semiconductor industry. Who are the clients? So it's mostly TSMC, Intel, Samsung, SK Hynix, Micron Technology Semiconductor Manufacturing International Corporation, which is a Chinese company. Okay, so generally, yeah, it's semiconductor companies that need high-end patterned up to or down to, I don't really know how to put it out, but 1.8 nanometers for now, maybe 1 nanometer by 2025. Okay, it's in the project. Okay, it's used for powerful computer like M3 chips that you have in MacBook. Okay, MacBook Air, MacBook Pro, the new Apple chips. Like they need this for cloud, for AI, for phone like iPhone, for cars. So it's going in powerful stuff. Okay, it's if you have an old computer, maybe you don't have this inside. It's generally for computers that are more powerful than average. Let's say they will need this kind of chips. So the sales by country, you can see that 29%, almost 30% come from Taiwan, 26.5% from China, 25% from Korea, South Korea, 11% from United States, and the rest other part of the world. By product, we saw it 80% machine sales, 20% service with the machine. The market here, the patterning semiconductor market expect to grow till 2033 by a CAGR of 5.14%. The high-end semiconductor is expected to grow 9% per year till 2030. Okay, the main competitors are Nikon, but does not have EUV lithography, only DUV, so they are limited to 28 nanometer nodes. Canon, DUV and nano imprint only for all nodes, so for them it's over 40 nanometer. You have Tokyo Electron. Here they don't have lithography, but they have some machinery to help produce high-end chips, not at same levels than ASML. So Canon and Nikon, they not for high-end chips. Tokyo Electron a bit, but not exactly the same way that ASML is in. For the market, here you can see the different type of company in which section of the semiconductor line they are. And you can see, compared to Applied Material, Lam Researches, even Tokyo Electron, ASML is only focusing on patterning, and patterning is one of the biggest market in it. And ASML dominated because they have 80% of this market. So they are really big in it. The team, since 2024, there is a new CEO. It's Christophe Fouquet. He joined the company in 2008. And the CFO is Roger Dassin, which have worked with Deloitte and so on. The owner is mostly institutional, like BlackRock 8%, Vanguard 3.9%, and I will not enumerate all of them, it's just like a professional. For the numbers, so we have a good growth, okay, in the past good growth, and a potential good growth in the future. The revenue had grown 18% per year for the last 5 years, EPS 21% per year for the last 5 years, and free cash flow here, it was declining for the last 5 years because a lot of capex, but still good growth for earning per shares. We have a predictability score of 5, which is good. And for the future, so for the last 2 to 5 years, we expect the EPS to grow 22%, which is very good. Apparently, it's more like 22% for the next 2 years, and then more around 14% for the 3 years after. And revenue 14%, and free cash flow 62%. It's 62% because it comes from down, so it have a higher upside. When it comes to efficiency, we have operating margin growing since the last 10 years, which is very good. Now it's 30%, probably thanks to the service business and the service that they are providing. We have a good and stable ROIC, okay, return on invested capital, around 20%. Sometimes it's 21%, sometimes it's 19%, but it's generally around 20%. And good return on asset, which is growing, which is now 17.5%. When it comes to debt, it's easy. They don't really have debt, okay? No debt to EBITDA, a debt to equity under 50%, interest coverage higher than 100, so perfect. Like no risk of bankrupt, no debt problem. They don't have any of this. When it comes to allocation, they do a little buybacks, 1.5% average for the last 5 years, every year. And now the last year it was 0.1%. The capex 5-year average was fine, 16%, but we can see that now it's around 40%. They increase the capex. So this is something to take care of. And stock-based compensation, not a lot, under 10%, so it's very good. They're also giving a dividend, which is not very high, under 1%, but still good. 10% payout ratio, so very safe. They have place to grow it for the future. 14 years growing this dividend every year without decrease, and I think 15 years without any decrease growing, but sometimes it was stable. And they're growing at 24% average per year, and I expect it to grow around 10% for the future, which is approximately following the revenue growth. When it comes to the quality score, it's 86%, well deserved. It's a very, very good quality company. For the product now, are the products essential? So yes, patterning is an important part in semiconductor fabrication. So the machines that they're doing, they're kind of essential. They're the only one able to pattern under 5 nanometer chips thanks to EUV machines. So the product is kind of essential in the industry if we need chips under 5 nanometers. If this is needed, yes. If we consider that this is maybe not needed, so here, they may not be that essential, but for now, they are very essential. Are the sales predictable? Is there any regularity? So yes and no, because ASML has regular incomes with services, but the sales of the machines are less predictable because they are expensive and it depends on the need of the market. If they need a lot of high-end chips under 5 nanometers, they will sell a lot, but if suddenly we need less, because for example, DeepSeek shows that we don't really need a lot of, we don't need that much power for AI and so on, maybe it will decrease the demand. So the sales are not that much predictable. So it's between yes and no. It really depends how you see the market and how you know perfectly this market. Is it a wide market with ton of clients? No. Only few clients can buy the machine because they are very expensive, and also because only few clients are using the thing. So it's mostly like TSMC, Intel, Samsung, and so on. Is it difficult for clients to change to competitor? Yes, it's very difficult because now nobody has a tech to compete with ASML. EUV, the first EUV machine was in 2010, 15 years after, still nobody is able to do EUV machine. Still nobody can print and can pattern under 5 nanometer. ASML is the only one able to do this, or only one able to go under 3 nanometers. And now they are going smaller and smaller. And going smaller is actually something good because you can put more on smaller, so it costs potentially less, but more of all, it's more efficient. It's more efficient and maybe will use less energy. So it's very good. A machine has also around 15 years, it lasts 15 years, and they are expensive. So they will not go to competitors in the middle. Like if you're TSMC and you have a machine, you will not change the machine brand in the middle of those 15 years when you're considering the price you pay and also all the service that you have with it. Are the products resilient to change and innovations? So yes and no, because according to Dev Kantesaria, he published a great analysis about ASML and he have it in his portfolio. ASML is 20 years in advance when it comes to tech, okay? According to some other sources, more 10 years, 5 years, okay? But the truth is, it's very difficult to know. My big question for me here, do we actually need such chips for now? Is it actually very necessary, or is it a hype with AI and so on? It's a genuine question. I'm not saying it's not necessary. This is not the point that I'm trying to make. I'm just questioning is it really necessary? Yes, they are in advance about technology, but for how long? Maybe a company will be able to find a way to, I don't know, just improve the chips without saying we need to go under 1 nanometer. We don't really know. But for now, I find that they are pretty well in advance in innovation. They've shown that they are very good in innovations, have very good products, they're in advance on competition, so not too bad. When it comes to the position of the company, are they market leader? Yes, by far, they have around 80% of the patterning market, plus they are the only one able to do under 5 nanometer chips, so huge market, they are totally leader in this. It's a monopoly, okay? It's literally a monopoly. Is the market open or closed? Okay, so can competitors enter easily? It's closed. It needs a lot of capex to create such machinery. A new entrant really need a great tech to take shares from ASML. The machines are huge and heavy, so need to have also good logistic. Okay, it's good to create good machine and so on, but then you need to be able to transport them and to provide them to the client. So here also another point that can be interesting for the Moat. Are they price maker? Yes, because they are the only one having such product, so they can put the prices they want to put. Is it easy to forecast growth? No, because it depends on a lot of external factors and on the demand of semiconductors, so not really easy. Are they dependent on geopolitics? Yes, semiconductor is a big geopolitical thing. Around 80% sales come from Asia, 55% from China and Taiwan. That can be problematic for the future. We don't know how it will go. Today there is a lot of restriction with China, so maybe they will try to do something inside. We don't know, but it can be a problem that we need to take in consideration. When it comes to the management, is it easy to manage the company? No, constant innovation, geopolitical negotiation, but I would say easier than chip designer. Like I think this is easier to manage than AMD, Intel or Nvidia. We've seen with Intel how difficult is it to manage because they change CEO every 2 years almost. But so here I find it easier than them, but still it may not be very easy to manage because I think you need to have a very good knowledge of the topic to manage it. It's not like managing a candy shop, okay? So yes. Is the debt level low? Yes. Are they doing any buybacks? They do. Is there a good growth potential? Should be yes. It's more difficult to predict, but there is, analysts are kind of confident to say it will grow around 10%, so yes. Is the company focusing on creating good products? Yes, definitely, and focusing on staying ahead of competition, because even if they are still the only one with EUV technology, they still improve it to go smaller and smaller on chips, so yeah. Are the important team member good? They seem to have experience in the company, plus the former CEO is still helping during the transition with the new CEO. So everything seems good. When it comes to strength, okay, so their technology leadership, the company maintains a significant lead in R&D and innovation with extensive intellectual property portfolio and continued breakthrough development in semiconductor and manufacturing technology. They have a monopoly in EUV lithography. ASML is the only company capable of manufacturing EUV lithography machines, which are crucial for producing advanced semiconductor chips. This gives them unmatched market power and pricing ability. They have a robust financial position. The company maintains healthy profit margins, strong cash flow, and substantial R&D investment capability, enabling continued innovation and market leadership. Plus, the margins are increasing, so this is also a good sign of pricing power. There is a high barrier to entry. The complexity of the technology, extensive patent protection, and decades of accumulated expertise make it extremely difficult for new competitors to enter the market. And strong R&D capabilities, ASML invests heavily in research and development, ensuring continuous innovation and staying ahead of competitors. Of course, there is some weaknesses. Dependence on a few customers. Okay, a significant portion of ASML revenue comes from a few large clients, making it vulnerable to their demand fluctuation. TSMC, Samsung, and Intel forecast less CapEx spending for the next years on machines. So take care with this, because there is different sources. Some will say they expect more CapEx, some less. The things that seem to come, okay, the more, you should do your due diligence on it. But from what I researched, they should spend more on CapEx, except for Samsung and Intel, but less on machines. The CapEx is more for other things. So I don't really know 100%. You need to do research, but apparently there is some serious forecasts that they will spend less on those machines. You have also a slow innovation cycle. Developing next-gen high-NA EUV machines take years of R&D, making it difficult to rapidly adapt to new technological shift. They also need big R&D budget. You can have some things that happen with Intel, that they didn't take the good turn on technology. They were focusing on working on some things that nobody wanted, that was not useful, and then they got lost. The same thing could happen with ASML. Way less likely, to be honest, because the management seems more competent, but it's something that may happen one day. We don't know. For now, I don't see it, but something to keep in mind. A supply chain vulnerability. Okay, ASML relies on global supply chain, making it susceptible to disruption. Example, geopolitical tension, pandemics, etc. A geopolitical also contraction. Major production facilities are concentrated in the Netherlands, creating potential risk from natural disaster or geopolitical issue. And also long production cycle. EUV machines take considerable time to manufacture and deliver, limiting their ability to quickly respond to demand spikes. For the opportunities, you have a growing demand for semiconductors. The rise of AI, IoT, 5G, and electric vehicle is driving increased demand for advanced chips, benefiting ASML. Expansion in services, growing potential in after-sales services, upgrade and user system sale can provide additional revenue streams. So those revenue will be probably have higher margins as well. The technological advancement, okay, continued innovation in areas like hyper-NA EUV and high-NA EUV can open new revenue streams. Growing in China despite export restrictions, despite EUV bans, China remains a major buyer of ASML DUV machines, offering a stable revenue stream. And also government support. Various country initiatives to build domestic semiconductors capability create new market opportunities and potential subsidies. The threat now for the market is geopolitical tension. I think it's one of the most the main one. Export restriction, particularly between the US and China, could limit ASML's market access. Supply chain disruption, global supply chain vulnerability, and potential material shortages could impact production capabilities. Cyclical industries, the semiconductor industry's cyclical nature, can lead to volatile demand and revenue fluctuations. Talent competition, increasing competition for skilled engineers and technical experts in the semiconductor industry could affect innovation capabilities. Alternative technologies, potential emerge of alternative chip manufacturing technologies could reduce dependence on traditional lithography. When it comes to the moat now, Morningstar gives them a wide moat with a positive trend, which is, I think, the best grade that they can give. So for Morningstar, they had 20 years in advance. Okay, they are protected for the next 20 years. They have a high return on invested capital, 19%. High barrier to entry, okay, monopoly on EUV, high cost to create machineries that can compete. Market leader, 80% of the patterning market and focus only on this market while competitor on other. High switching cost, the machine is expensive and lasts around 15 years. So for at least 15 years, the client will pay for ASML maintenance service. We can also have probably a pricing power and also increasing in margins because operating margin is increasing. Generally, it's a good sign of a moat. Before getting to value, here are some few questions that I asked myself about this company, and that answer can be very different. So I will be curious to know your opinion on this in the comment section, because I think it's some important question to ask before considering an investment in this company. Government support, okay, can help to grow on short term, but I'm afraid that if the market only depend on it, it can create problem. You have a lot of government program support and subvention for semiconductor, for those things, and I'm afraid that if they stop it, it can create less growth, okay? Do we actually need 5 nanometer or less, or it's a trend because of government helps, AI hype, and GAFAM huge cash available? If we were not in a situation where GAFAM had all this pile of cash, if government were subventioning AI and so on that much, and with all this new, seeing new hype around AI, will those companies spend that much to ASML, will spend that much to create new chips and so on, and to have less than 5 nanometer chips? I don't know. I'm not saying they will not. This is just open question. You just need to think about it, think by yourself, do research to see if this can be a problem or no. Maybe it's a stupid question that there is no problem about it, but I think it's important to ask about it. Also, the fact that DeepSeek is 95% less expensive than ChatGPT will slow the demand in high-performance chips. So less work for TSMC, which causes less sale from ASML. Okay, this is a potential scenario. We just realized that, okay, DeepSeek can do better than ChatGPT with less GPU, with less power. So maybe we don't need that much power. Maybe we don't need all of this. So we don't need to buy all this from TSMC. So TSMC will not need those new machines. But it can also be the opposite. It can be, okay, we realize that AI finally will not be that expensive. So we can have way more for less. So we can ask for more and more and more GPUs, more and more chips. So here it can increase the demand. So 2 point of view here. I would be curious to know which one is yours in the comment section. So now when it comes to value, first thing we can see is ASML, you pay it for a way higher valuation than Nikon, Lam Research, Applied Material, or Canon. Okay, the average is 21 forward PE ratio, while for ASML is around 28. So the price now is around 700 euro. So it's moved, okay. But at the moment I record the video, it's between 680 and 720. The 10-year average forward PE is 27.7. The actual PE is 37.1. The forward PE is 28.7. The expected revenue growth rate is around 10% per year. And the expected EPS growth rate is around 14% per year. I took those data from Guru Focus. So based on those data, now let's get into my valuation spreadsheet to check at what price it can be interesting. So we have share price around 27. We can expect a future PE of 27, 25. Okay, the average was for the last 10 years was 27.7. The last earning 7,512. Okay, with a growth rate of 18% per year. They do buybacks around 0.5% per year. Okay, it's the average is the last one is 0.1. The average is 1.5. So we can say they will do 0.5. With all of these, you will have a return around 9.86%, 10.64% with dividend, with a dividend growing 10% per year. So it's possible. Okay, it's I think this is kind of a fair value for me. I'm looking for 13%. So if I want 13% with those data, I need to buy at between 600 and 610 euro if I want to do 13% per year for the next 5 years. Now, some analysts, also Dev Kantesaria, is pretty confident that it should go around 20%. He say between the high end of 10s and 20%. So if we have 20% growth, here we have 11. Okay, so if the company grows 20%, we have 11% per year, 12% and half almost per year with dividend, which is pretty good. And if the PE that we expect in 5 years is more around 27, so 27, which is kind of the history for the last 10 years, we could have 13% growth, and we just need to have a fair value of 714. So if you buy under 714, you can expect to grow a bit more than 13% per year. So if you believe in this scenario, 13% per year is possible. It's possible to do more than 10% per year. I prefer to take a bit more margin of safety. So for me, I will put 18% per year growth. Okay, and here 25, just because I prefer to take more margin of safety. So here, like under 10%, for me, it's not really convinced for now. Okay, maybe if a big drop arrives, but in terms of valuation, I'm a bit skeptical. So for score, we have a quality score of 86% and a value score of 60%, which is pretty good. To conclude this video, so it's a great company with a monopoly on EUV, a wide moat on it, like apparently they are almost 20 years in advance, so they're already since 15 years, they are the only one doing it, and for the next 10 to 20 years, apparently it will still be the same. They have a solid tech position and advanced compared to competitor between 5 and 20 years advantage. We need to take care on China restrictions, depend on a few clients and on the high-end needs, okay, on the high-end chips needs. Do we really need them or we need that much? Okay, so if you believe ASML profit will grow higher than 19% per year, it can be an interesting opportunity. I would consider entering only if I can expect 13% per year. So for now, the company is in my watch list. So you take your decision. I think we kind of deep dive into this company. Let me know in the comment section, what do you think about this company? What do you think in this analysis? And also you can recommend me some stocks that you would like to see in deep dive. Remember, one thing is most of the deep dive, I will focus on good quality companies that I could potentially consider them for my portfolio. So let's avoid those meme stock and so on, please. Let's just focus on quality business. That can be a good opportunity, even if they are overvalued. It's always good to analyze them, to have them in the watch list and to know which price can be good. Like this, you gain time on analysis.